everything and introduce our guests. My name is Ben Rainey. I'm a partner at WealthPoint. We're glad you took some time this morning to join us for what we think is an exciting 90 minutes of education. We hope to do our best to not only educate you guys, but also hopefully give you some great material for you and your clients and your practice. We're going to do our best to keep it energetic and entertaining as best we can. That's why we have Ken and Vimala with us. They bring all the energy, and so with that, I'm going to introduce them. We've known both of them and worked with both of them now for, probably almost 4 years. And rather than give a long-winded introduction, I'm going to have them each introduce themselves, and then Frank will take it away. So, Ken, why don't you introduce yourself and tell all our guests that are waiting with bated breath all about yourself and how you got into PPLI and why you agreed to be on this webinar.
Yeah, absolutely. No, thank you. Thank you, Ben. Thank you, Frank. Thank you to the WealthPoint team for having me here today. And thanks to everyone who logged in and gets to spend 90 minutes with all of us today. As I mentioned, my name is Ken Foley. I'm CEO of Spearhead Administrative Services. We provide administrative services for third-party investment managers inside the private placement life insurance space. I guess I could say my private placement experience is detailed and long from there. So I started in the PPLI space in 2001. So I've been doing this for 25 years. Prior to joining Spearhead in 2019, I spent the previous 18 plus years of my career at Lombard International, which is the world's largest private placement insurance company. When I started in 2001, I was employee 16, and the firm had 200 million of AUA. And when I left, and since nobody else from Lombard's here, I will take all the credit. When I left, the firm had 500 employees around the world and over 80 billion of AUA. So I've been involved in basically my entire professional career has been exclusive to private placement life insurance, and appreciate the opportunity, spend a little time and go through what I refer to as the art of the possible with all of you today, and hopefully leave you with some useful information to take away. So thank you again, Ben and Frank, for having me.
And I'll jump in next. Yeah, so my name is Vimala Snow. I'm the head of wealth planning and wealth strategy at Cresset. We're an RIA multifamily office in the space. Have really been digging into PPLI over the past couple of years, partnering with everybody on the screen here. But by training, I'm a lawyer, so I'm recovering at this point, no longer practicing, but essentially rely on my experience having been a partner at Withers Bergman for a number of years, and then stepping over to the wealth management side, first with Abbott Downing and now with Cresset for a little over 5 years. So take a little bit of a different approach. Have been really lucky to partner with these guys to come up on all of the practical implications of planning. Really spend a lot of my time focusing on the legal structuring aspects and really understanding how it can fit into our clients' balance sheet, how it can help from a tax and estate planning perspective. So excited to be able to share hopefully some of the practical ways to incorporate it for your families. Really happy to be here. Thanks, guys.
Awesome. Thanks, Vimala. My name is Frank Hirsch. I'm a partner in the Insurance Advisory Services division at WealthPoint. I am also a recovering attorney. Although I spent the bulk of my career prior to entering this world as a derivatives trader. And I remember the first day I was down on the floor clerking, and the person who was helping educate me was describing these option contracts are just simple insurance contracts. And that concept has really informed my practice today, because two of the things that I really think about are hedging, being very specific about what risks we're actually trying to hedge, but then also thinking about where's the edge coming from? Where's the alpha coming from, right? And I think both concepts are very much applicable in the private placement world as we go through the presentation. I think that those two concepts are very much going to resonate. All right, so we're going to do a little bit of housekeeping and sort of see what's on the agenda for today. So we've got a full meeting. And by the way, Ben and I encourage everybody to participate in the Q&A please, that's going to make it much more interactive, and we want to address the questions that everybody is really thinking about. So the learning objectives for today is to understand the basics of private placement, the potential tax savings, and the impact. Review what's an SMA, a separately managed account for RIAs and MFOs, multifamily offices. What has been the change in the industry over the last 5-10 years? And obviously Ken, with his history, is the perfect person to sort of really see why are we seeing rapid adoption of private placement structures today? And then obviously identifying ideal client fact patterns to help all of us provide appropriate services for our clients. We want to identify advanced planning considerations when implementing PPLI, funding considerations, offshore and onshore opportunities. What are the differences? Where's the market gravitating to, and why do certain clients gravitate to onshore and or offshore? Reviewing applications for single family offices, sort of echoing Ken's earlier refrain of the art of the possible. What is possible in that particular world? And obviously investor control issues. And then how can we use existing life insurance within the PPLI structures themselves? Again, I encourage everybody, as does Ben, to put your questions into the Q&A feature within the Zoom toolbar. And if you are interested in receiving CE and CFP credit for attending, we will be sending out an email for a survey to be completed, and then CE certificates will be mailed to you within 30 days of the webinar and completion of the survey. If you have any other questions, please reach out to Kristen at WealthPoint. All right, so let's just try to understand, the basics of what is PPLI. So PPLI is an institutionally priced life insurance product built on a variable universal life chassis. It is designed for investment performance and not death benefits. So what does that mean? That means that we are attempting to use the minimum amount of death benefit in a particular contract, both at inception as well as during the life of the contract, so as to reduce the cost of insurance charges, which will only serve as a drag on the investment performance. This really is about the underlying assets within the private placement structure itself, and the insurance is really being used as the wrapper. So we're not emphasizing death benefit, we're minimizing the death benefit. One important distinction in private placement as compared to traditional insurance is there are no surrender charges in private placement. Okay? And the pricing is fully disclosed, totally transparent in all aspects. As far as the investments, and this we're going to get into a lot more detail in a discussion between Ben and Vimala and Ken. There's two different approaches. Most common is something like Cresset, who is an approved manager. They have a SMA program in which their firm has become an approved manager. And so what does that mean? It generally means that whatever Cresset is able to do on the taxable side, they are now able to do within the private placement structure itself. These funds are not at risk with the insurance company. They are not commingled with the general account. They are separately managed. And those funds they use the same custodians that, a Cresset would use on the taxable side. So it very much looks like whatever they can do on the taxable side, they're going to be able to do on the private placement side. And obviously, as we're going to talk about the taxes and what are the tax implications, you'll see that there might be reasons you're going to hold certain assets in a taxable account and certain assets in the private placement structure. So the tax benefits, and this is really why ultimately I believe, and I think this is going to be echoed by all three of the other panelists, is private placement really is an asset location story. And the more tax inefficient the asset, the greater the benefit of the structure itself. So what are those tax benefits? One, the underlying cash value of the investments themselves are growing tax deferred. And so long as the investments, the private placement life insurance structure stays in place, the growth will actually be tax-free. There will be a tax-free death benefit at the end of life. And during the life of the insured, there will be tax-free access to the cash. Typically, it's first a withdrawal basis, and then you're going to use policy loans, and you can extract the trustee, typically owned by an irrevocable trust. The policy owner will be able to typically take out, should they desire, about 90% of the total value out of the contract if they wanted to make distributions. The fourth point is, on one hand, I would say obvious, and on the other hand, it is slightly more subtle. The first three are quite often talked about. The last one is, in almost all cases, private placement life insurance is held outside the taxable estate, inside a grantor trust. This will be the only asset inside that grantor trust that will get a step up in basis equivalent at the end of life, because all of the gains will be converted into an income tax-free death benefit. So we can just easily distinguish that between another asset in the grantor trust, which retains the basis of the grantor, and ultimately those buildup of long-term capital gains, let's assume, will ultimately have to be paid by whoever the beneficiaries of those trusts are, or if there's distributions made during the grantor's life, those will also be incurred. Here, there is a step-up equivalence. PPLI is not actually called out in the tax code. It is part of a long history of codes that deal with life insurance in general. So there have been discussions within certain government bodies of private placement, but just remember, it is not specifically called out in the tax code. Let's see.
And I think that's an important point,
Yep.
Frank, that we shouldn't overlook. And that's, you know, our thoughts and our clients' thoughts instantly go to regulatory risk. And I think when you see, and we're going to run through a case study, a lot of this stuff, we're covering the basics just for anyone who hasn't seen this already. But when you see the outperformance that PPLI offers our clients, a lot of clients instantly go, man, this is too good to be true. Congress is going to claw this back. They're going to go after it somehow. Knowing that PPLI is a vanilla life insurance product really helps kind of calm their nerves around the idea that there might be some sort of regulatory risk down the road. So knowing that, again, PPLI is not called out in the code section and not distinguished in any way is, I think, a real critical point.
Yeah. You know, Ben, and I think just to sort of lay the groundwork, because I know you and Vimala and Ken are going to get into a deeper discussion in a second. I do want to go back about the investments. Typically, we are working with RIAs in terms of setting up separately managed accounts for them. There are insurance dedicated funds which exist on life insurance platforms. Those, so Bain Capital, Ares, Golub, Golden Tree, Millennium, those are popular insurance dedicated funds that exist on some of the insurance platforms. Those are also available for investing. So it's not simply, let's say you do have a manager that's approved that can do anything they want. Not only do they have what's available to them, but they will also have what's available on the platform within the insurance dedicated fund world. So that's going to be, as I mentioned, several of them, hedge funds, fund of funds, although they also have, in addition to the unregistered funds, they do have registered funds called VITs. So you can imagine at Ken's old firm Lombard, for instance, they've got 50 different Fidelity funds. So those are also available in terms of investing. And we'll get into the nuances between the SMA and the IDF later, but I just wanted to make sure I covered that groundwork.
Yeah, it's not an either or decision, right?
Yep. And so, as we move into the next section, when I first started talking about PPLI 10 years ago, I think that I often say that it was the most talked about, least implemented tax strategy of all time. Everybody loved it, and it sounded great initially, and then you started diving into some of the details, and it wasn't necessarily as good as they maybe had thought, right? But clearly, the world has changed. And so I'm going to hand it off to you, Ben, and the other panelists, and really talk about what are those key drivers of PPLI growth? I mean, what has changed in the last 5 years?
Yeah, it's a great point, Frank. And there's a lot of reasons why on this page that PPLI, that we've listed here, that PPLI has increased in popularity and in application. But what I want to do is really turn it over to Ken here at this point, since you've got the longest history in the space, and say from your perspective, Ken, maybe speak to it, and Vimala, I'll have you answer the same question. Why have you seen clients not do it in the past, and how has that changed in terms of what we're seeing now from the landscape?
Yeah, absolutely. No, thank you, Ben. So I think WealthPoint put a lot of great bullet point options here and all of them speak to the sort of groundswell that the private placement marketplace has seen over the last 5 to 7 years. From that standpoint, I'll start with the first one, the SMA application. So separately managed account programs, as Ben and Frank have discussed, and they allow registered investment advisors to build custom bespoke investment mandates by client, by policy, by family. So basically lifting up their taxable investment model and dropping inside these private placement life insurance product from there. So it allows them to, again, the RA or multifamily office to have full discretion to use their preferred custodian to build a custom bespoke portfolio for their client using their own internal investment menu. So stocks, bonds, ETFs, mutual funds, hedge funds, private equity, real estate, VC, whatever it is, the investment magic that they do, they're able to deliver that inside the private placement life insurance product from there. So it allows them to do that as opposed to being limited to picking off the carrier's lineup, investment menu lineup from there. So when you think about the last 3 to 5 years, as I mentioned, I've been doing this for a minute. So go back about 15, 18 years, there was really only a couple carriers that allowed separately managed account programs inside their products. It was not, the reason for that wasn't anything to do with they weren't allowed or it was risky or anything along those lines. It was simply based around the fact that they were investment and technology savvy, as opposed to other insurance carriers who literally didn't have the internal technology to allow those types of programs to be run inside their systems. And so what's changed over the last 5 years is, and how the adoption of this has grown, is that it's allowed carriers like Prudential and Pacific Life and Zurich have all come around, if you will, and partnered with administrators, firms like Spearhead, like mine, to provide that administration for them, and in essence act as a TPA for the insurance carrier. So they don't have to build or adjust their own internal technology, which would take decades, as we all know. This therefore allows the expansion because the carrier optionality has increased. And when you add names like Prudential and Pacific Life and Zurich to the number of carrier options that allow for SMA programs, that obviously helps with that sort of wider adoption through the RA marketplace. In addition, you have more RAs that are sprouting up every day in multifamily offices. So when I say RAs, I mean RA/multifamily office. I may forget the MFO at the end sometimes, but just they're the same from that perspective. So what you're seeing is more RAs, MFOs are sprouting up every single day, teams popping out of wirehouses that have PPLI experience based on where they are, They're starting up their own thing. They want to make sure they have the same services that they had previously, which would include the ability to manage client money inside here as well. And then you're having the larger, sort of institutional national registered investment advisors like Cresset or Vimala is that, fully understand it, have that wealth planning component like Vimala at Cresset that allows for internal conversations and support. So that is a long-winded answer to saying the growth of the marketplace is really being driven right now by the separately managed account programs and by the RA/multifamily office space. They are the ones that are really driving the increase in activity within an issuance of policies and just the overall market and education as more and more of these RAs adopt and create these programs. The addition of the carriers allows for more carrier optionality for those RAs. And so it really is kind of came together as a perfect storm over the last 5 years. And the growth has been exponential for all carriers with the adoption of the SMA programs.
So Ken, real quick before I get to Vimala, and I put you on the spot and I didn't tell you I was going to ask you this question, but if you don't know it, you can just say you don't know it. But in terms of revenue growth or premium growth, maybe in the SMA versus IDF, I know IDFs, the insurance dedicated funds, are still the bulk of the market. Sure. And there's a lot of institutional money in that space. But in terms of the acceleration of funds in the SMA, can you speak to? I spoke with Prudential early this year, like in April, and they had already matched their premium number from the year prior, and they were like 3.5 months in, right? So it was like they were just seeing ridiculous amounts of growth in the SMA. So I don't know if you can speak to that with actual numbers. You might just say, I know it's big, I just can't speak to it. So real quick, if you got that number.
Yeah, no, I'm going to lean into what you kind of just spoke about. So I'll use Prudential as a perfect example. So we were hired in 2001 to build out their Prudential's SMA programs. We spent 2 years working with them behind the scenes, yada, yada, building up, connecting all the piping and plumbing together on their side till they finally went live 3 years ago. So if you think about it, they're from a new premium dollar standpoint, 3 years ago, they were 100% of all dollars coming in went into insurance dedicated funds because they did not have separately managed account programs. Then the first year, it was 70% IDFs, or excuse me, 80% IDFs, 20% SMAs. Then year 2, it was 60-40. And this will be year 3 for them with their SMA program. And they will be 50-50, maybe 45-55 in the SMA favor. So within 3 years, the entirety of Prudential's 20-year private placement sort of program in regards to new dollar flows has flipped on its head in 3 years and gone from 100% IDFs to now 50 to 55% are now flowing into SMAs. And you can see since its adoption, it went from 20 to 40 to 55. And then who knows, next year it may, increase even further. So yeah. that kind of reflects the overall adoption rate is exponential.
That's great. Vimala, so Cresset's entry into PPLI has been more recent than Ken's, the grizzled veteran of Lombard and all that. But you want to talk a little bit about how you guys have approached the space and what kind of growth? I mean, you guys have gone from 0 to hundreds of millions. I don't know what your latest count is in terms of AUM, but it's been exponential as well.
Yeah, I think we're probably approaching 500 million also in the past, I think 2 or 3 years. So probably right along with the growth of this SMA program at Prudential, saw the writing on the wall and really wanted to get up to speed and become a part of the marketplace, as early as possible. As Ken was saying, with the ability to jump in, you want to do what everybody else is doing. But more importantly, we really want to provide our clients with the ability to tap into the things that are going to be most helpful for them. So I think if we're taking that client view of why we're seeing more and more of it, there's, a lot of advisors who are becoming more and more educated, whether it's CPAs, attorneys, wealth advisors, and really clients are expecting their team to understand these concepts. They love that it can just be one other tool in the toolkit that is available and can be integrated into their whole picture and their whole wealth management approach. So I think having that team surrounding them really does make it more comfortable. I think historically, when I was practicing, we would do some PPLI and write these large policies. And it was always explained as this is really complicated. It's really challenging. And, there's all these rules and regulations we have to follow. And what I've seen now sort of on the other side is if you have smart people who know what they're doing. It's just another form of insurance. The structuring doesn't need to be that much more complicated, and we really can just fold it in to existing planning in a way that helps our entrepreneurial clients who are really tax sensitive get better returns over time. So I think just changing the narrative a little bit, but with a much more educated team of advisors around folks has really, I think, given clients a lot of comfort to step into the space a little bit more as well.
And Vimala, are you guys fielding inbound calls on PPLI? I mean, I know you guys are doing a lot of marketing in this space as well, but are clients calling you, prospects calling you and saying, hey, what are you guys doing in this space?
Yeah, certainly. I mean, a lot of the, articles you see in the New York Times, and people are hearing about, the Senate and what are they saying. And so it's certainly something that people are reading about, their friends are talking about, they want to understand a little bit more. I think the advisor corps, as I was talking about, are also getting more educated. So we're doing a lot more just sort of conversations with folks professionally around it, who are then having conversations with clients, and really happy to be able to, continue to sort of spread the word and talk about it and try to hopefully make it a little bit more practical and approachable as well.
Yeah, awesome. Before we move off this page, I want to address the very last bullet point on this page, which is seemingly kind of a throwaway bullet. It's kind of like the last bullet, nobody reads it. But interestingly, I've had 3 advisors in the last month mention how expensive they thought PPLI was. And so as just a quick carrot for those who may have, again, previous history, back in the 80s, 90s, early 2000s, they went, oh, the insurance was expensive in this space. There have been some tweaks to the tax code that have allowed for the cost of PPLI to come way down, probably half of what it used to be. And we can get into that later. I don't want to belabor that point. But if that's kind of a hang up in your head as to, man, this is why I've seen it not been implemented in the past. I mean, it was always a good deal, but it's gotten even better now. So we can move on from this page, and happy to talk with any of you about any of these issues or any of these reasons why PPLI has taken off further, but we'll hold that for another conversation. So on this page, and actually the next 3 pages, what we wanted to do is just shed a little bit of light on the commonality of what we're talking about. Meaning, like for a lot of clients in particular, PPLI is, again, it's this kind of talked about thing, but nobody really knows who's doing it. And are there real sophisticated players in this space and all that? So what these 2 pages show is there are some really sophisticated players, brand names, marquee names in asset management. You can see there, Golden Tree, Goldman Sachs, Third Point. Blackstone, right? This is not some back of the napkin, backwoods, Arkansas kind of style investment, thing, right? It's the major players are involved, and it's becoming more and more common. The next page simply shows all the SMA players, not all, a lot of the SMA players. These are the SMA players that we have engaged and have worked with in the past. I'm sure there's a handful that we have left off here, but there's a lot of very significant asset managers out there. And Ken, if we asked for your list, it'd be, many times this list here. But these are all different ways to enter this space. So this is the SMA space. The previous pages were about the IDFs, so the insurance dedicated funds, the VITs, those are like the mutual funds. But there's a lot of different investment options here. And as Ken mentioned, that SMA platform where you can kind of do both the custom asset management, but as well, if you saw back on the previous page, you saw Bain Capital. Most of Bain's funds, I think it's on this page anyway. Most of Bain's funds require a $25 million minimum. You can actually get into Bain via an IDF. I believe the minimum's $1 million. Ken, you could correct me if I'm wrong, but I think you can get into Bain's. It's kind of their fund to funds for $1 million. So it's a very approachable way to get into some of these higher end funds that you can't get to otherwise. Then the last page here, all these logos we're throwing at you is just more familiarity. The carriers that are in this space, Ken mentioned these, Lombard, Pru, Pac Life, Zurich, and Lincoln actually is a new entrant. They're going to be launching their product in 2024.
So in general, there are 2 rules that really govern private placement structures. We've already got a couple questions on this, so we can spend a couple minutes on this page and hear both of your perspectives. The first is investor control. And I would basically sort of summarize investor control as saying the policy owner cannot direct the fund manager as to what to buy and sell, right? And then, the details and the fact pattern sort of matter, but in general, the guideline is the policy owner cannot tell the fund manager what to buy and sell. In 2015, the seminal case in this particular area is the Weber case. That is going to provide lots of details as to absolutely what not to do. It's the fact patterns are it's pretty egregious. I think the real world in most cases it's a little grayer at times when, you know, we stay very much within the guardrails, but there are people who try to push and want to be more aggressive. Weber does give you sort of a path of what not to do. I will also say investor control and Vimala, and you know, I'd like to hear you weigh in on this. I see investor control and that concept is really the primary reason when you do have the ideal client fact pattern. This is when it fails, and it fails because that particular client wants their hands on the wheel of all investment decisions. And so I think you would agree, right? That
yes,
that
100%.
client, if you have a client that can't get their hands off the wheel, private placement is simply just not going to be appropriate. Is that fair to say?
Yeah, I think it's really fair. And, you know, just from a structural perspective, we've taken a very conservative view of this, frankly. We have an actual investment committee that is not otherwise talking to clients. So if we have taxable money and PPLI money, the folks managing the investments in their private placement life insurance policy are not otherwise interacting with the client or even talking to them about their taxable brokerage account. We certainly want to hear from them, right? Develop an investment policy statement that's in line with the liquidity profile that they want, sort of growth and lockup, and, you know, all of the other parts that go into what an investment mandate looks like. But other than that, really do try to segregate and make sure that they're comfortable, you know, actually taking their hands off the wheel. We've actually backed down from some policies where we've seen clients who just wanted to be too involved and wanted to be constantly throwing us deals and saying, here, put this in my account, and having, you know, overly sort of directional conversations around the types of things that they wanted to see. And we really view our role not only as to just manage a good program, but to make sure that we're protecting them, frankly, from themselves as much as possible, so that we don't run into all of these bad sort of outcomes that might otherwise arise if they're too involved.
And Ken, can you comment on two of the things that Vimala just brought up, which were great? So one, Cresset does have, right? They have really bifurcated that taxable world and the private placement world. Is that common? We already have a couple questions on that. Is that a common practice within the registered advisors? How do advisors maybe who don't have that sophisticated setup like Cresset does, how do they handle clients talking about their taxable account and it not sort of bleeding over and creating a worry that, oh, you're getting into a gray area of investor control in the private placement world? And then second, if you could just sort of describe the investor policy statement, how detailed it can be, how often it can be changed, and what that looks like.
Sure, absolutely. So, every RA is different in regards to how they manage client money. From that perspective, from ones that are, $1 billion to those that are 40 billion plus, like Cresset, right? From there, so that every RA is set up different. Everybody's investment management stylings and internal process and protocols are different. From there. So our job as administrator, when we build one of these programs in partnership with our RA MFO client, is to learn how they operate today. From there, understanding that in every situation here, they are taking full discretion of the investments here. Most likely in every scenario, they have a relationship. In most scenarios, they have a relationship with the client that extends in the taxable world as well. They also have full discretion there. So we start with, you have a full discretionary relationship. They accept that, honor it, and understand it. They also understand the ability that they have in regards to education, in regards to what they can and cannot speak about with the client. In regards to, you cannot provide any pre-order information or conversations in regards to any allocations you may be making in the future. So no future conversations are had as it relates to private placement and the money management inside. The other thing is they can certainly talk about their market and views and where they think the market's going to go and different asset classes and things like that, but they can't be specific to managers or securities or anything along those lines. Those types of directional conversations are completely off limits. So one is education at the RIA standpoint. The third item is, as the administrator, we at Spearhead work with the RIA to learn again about their investment magic. Many RIAs have pre-approved securities lists internally in regards to individual securities, alts, whatever it may be, that these advisor teams then work with and can build allocation models specific to their client. We, Spearhead, are given a copy of those allocation models. So when we receive those allocation requests, we can review and make sure that they're picking off the pre-approved list of the firm of which they are employed. So we are able to track those investments to ensure if they're allocating a lot to these types of securities, and then all of a sudden this one policy all the way over here is doing something different than everybody else, well, that's a red flag in regards to the conversation, things of that nature. Separately, the client, so that kind of speaks to investor control in regards to the sort of bifurcation that is done outside of going the way of building SMA like Cresset did, which is outstanding. Other firms are going to do it the way they do it from there. And there's obviously lots of controls and implementations in place to ensure that there's no egregious violations or no undue influence, I would like to say, from the policy owner on the investment. Separately, as it relates to the investment policy statement, or IPS in our world, the RA and the client can absolutely work together in the drafting and creation of that IPS in regards to types of asset classes to include, weightings by asset class, all that sort of stuff is perfectly acceptable and allowable. What you can't do at the end of the day is the client can't say buy Apple and sell Google, right? From there, they absolutely can have input in regards to, like I stated, asset class exposures, weightings by asset class, things of that nature. The other thing with the separately managed account program, specifically the IPS within it, is the investment policy statement is a living, breathing document. And what I mean by that is, as long as the policy is in force, that IPS can be updated throughout the lifetime of the policy, meaning you can add different asset classes later in life. You can readjust the weighting exposures by those asset classes throughout the lifetime. So basically what you do on day one isn't what it's going to be forever. You absolutely have the ability to make adjustments to that IPS to allow the RA to have that discretionary sub-advisor to have full authority to readjust as they see fit in conjunction and partnership with the policy owner as markets change, client requirements and sort of lifestyles change and things of that nature.
I'll just maybe throw in really quickly also, we work with Ken on a bunch of our policies, and every quarter they're reaching out and asking us for attestations that we haven't taken any direction or otherwise done anything that would violate this rule. And so it's another reminder, separate and apart from our policy internally, to be very divided. But every quarter, you know, everybody involved in the management of that policy is being reminded and asked to attest to the fact that they haven't in fact actually done anything wrong as well.
That's great. The diversification, I think, is pretty clear for most people. There's really two questions that I get. And by the way, so just for the diversification, one asset can't be greater than 55%, two assets greater than 70, 3, 80, and 4, 90. So we need at least 5 assets there. Two questions come up. One is, okay, if Cresset invests in a private equity firm, do they look through the private equity firm to see, well, they've invested in 100 different deals? And the answer to that is no. That is looked at as a single asset within the SMA program. On the insurance dedicated fund side, those are by definition both qualified for investor control and diversification purposes. So those look different than the SMA. So it is important to understand, are you in a allocator program to an insurance dedicated fund, or are you in an SMA program And even in an SMA program, if you allocate to an insurance dedicated fund, that will also just be a single asset within that program. But Ken, the question that I often get on the diversification, because we just went over the percentages, it's pretty simple. But what happens if day one, the client, the policy owner has their largest asset is basically 55% of the total. And then through organic growth over the next year, it actually grows to 65 or 70% of the total. Is that client in violation of the diversification rule? Do they have to take corrective action? What happens?
Sure. No, that's a great question. So I always like to start off with saying the policy owner and the advisor will never be penalized for making a good investment. So to the extent that the allocation grows outside of the diversification testing based on on performance from there, they absolutely do not have to make any adjustments to that portfolio to come quote unquote back in line, because the growth was based entirely, as you stated, organically or performance related. It was not, they didn't get outside the testing based on trades made by the investment manager. Now, at some point down the line, should the RA or the discretionary sub-advisor look to make a change to the overall portfolio, once they go in to make some trades and make some adjustments, at that point in time, they would need to adjust it to fall back within the diversification testing. But until they decide on their own to make a change to the portfolio construction, they do not have to adjust based on getting outside of diversification based on a great quality investment selection and the client benefiting from the great investment selection of the sub-advisor who they allocated to manage their money from there. So the one thing I would add real quick is just on the diversification testing is the rules here, as stated, whether it's investor control or diversification, are the same no matter what construct you have in here. So whether it's a separately managed account program, an insurance dedicated fund, or a VIT, which are the mutual funds, the rules are the same. Diversification has to have 817, investor control, can't take any direction from an outside individual on any security selections, so on and so forth. So if you take the next step and you think about, as a policy owner, the policy owner selects a mutual fund or a Vanguard fund. The Vanguard fund is going to have, they're selecting one singular equity fund or balanced fund or whatever it may be. That will already meet the diversification. So that meets the diversification test. The client may select an insurance dedicated fund like a Millennium or a Golub or something like that. From there, again, that fund as built is already diversified and meets those rules. The only investors can be segregated separate accounts of insurance companies, all these sort of things. So again, that fund as itself already meets diversification testing. So when
Ken, just to be clear, so a client could open a PPLI policy, put $5 million in it, buy Golub, and be done.
Correct, 100%.
Yep.
And then when you get to the separately managed account program, they're the sub-advisor. You look at it as one allocation, they're allocating to that sub-advisor. The sub-advisor now has the ability to build that custom portfolio. The sub-advisor, same thing, has to meet those same minimum 5 securities within those percentage guidelines. So at every level, it's the same, no matter which structure the client chooses. And to Ben's point, the policy owner, all private placement life insurance policies are owner-driven. What that means is the owner decides where to allocate their money. So they can allocate to the mutual fund, the VITs, they can allocate to the IDFs, they can allocate to an SMA, or they could do A, B, and C from there. So it's always up to the policy owner. They have full discretion as to where their money gets allocated to, and they make the decision on who gets the money. And to Ben's point, you can do 100% into one IDF. You can spread it around multiple IDFs. You can spread it around multiple mutual funds. You can allocate to one SMA manager. You can allocate to multiple SMA managers, or you can allocate some money to mutual funds, some money to an IDF, and some money to an SMA. So a lot of investment flexibility at the end of the day for the policy owner. And they ultimately, to Frank's point, they have their hand on the wheel. They decide who gets the money, but it's always an independent third-party investment manager that's picking the underlying securities, whether it's in a VIT, an IDF, or an SMA program.
And one other just quick follow on, right? Even though the policy owner is in charge of making that decision of where to invest, it really is on the investor to make sure that diversification is being followed. So that actual compliance doesn't sit with the policy owner to be monitoring and making sure that those trades are happening. If you hire Cresset to manage, we, with the help of Spearhead and sort of the people running the policy, are really the ones taking ownership of that diversification and making sure that that's complied with. So while there is choice, I don't want it to come across as the policy owner being the one that is monitoring and making sure that it falls within these rules.
That's correct. Once the policy owner has allocated their assets to a manager, and then the diversification and all that sort of stuff falls on the manager to meet those sort of guidelines from there. So absolutely right. Thank you, Vimala.
Yeah. All right, Ben, maybe I think at this point, let's run through an actual case study. And so we can see the numbers. I often say this is, right? This is an asset location story. That's just an Excel spreadsheet problem, right? So why don't we go through the numbers?
Yeah, we'll do that. And for those who have seen this before, this is our standard go-to model, just to kind of talk through with a client or an advisor team. Hey, what kind of improvement can we make for your clients by implementing PPLI? And so just a real simple fact pattern here: 50-year-old male business owner, lives in Colorado, has got a total net worth of $100 million, and of that 60 is liquid. And what we're going to do is we're going to isolate 20 million of the 60 to relocate, as Frank just said, from taxable accounts into a PPLI account. A quick summary here of the expectations around tax and return. So expected return over the long period of time is 7.93%. We get this information from the client's advisory team. So this is the asset managers, the CPAs, everything like that. Average annual tax rate, 34%. That's just the turnover, ordinary, income, long-term capital gains, dividends, all that fun stuff. So functionally, what those two things right there give us, the 7.93 and the 34% tax, gives us a cost of tax at 2.7% annually. Functionally, what that means for the client is the net rate of return after tax is 5.73%. All right. And this is important, again, because by quantifying the tax cost, we're able to show him the improvement that he's going to have by choosing to pay insurance charges instead of tax.
Nope, sorry.
That's all right. So real quick, and again, this goes back to, we keep reiterating the same ideas and themes because we think it's important, but this is an asset location story. So what we do, again, this is just a typical balance sheet for this client. It's got money in checking, IRA, 401k. There's that brokerage account, and then the positions to remain in the brokerage account. So this is just, the client already owns these funds taxably. He owns Starfire, Golub, Aries. He's got some money in a private equity fund, and then he's got $2.5 million in equities. And the story here is, again, Mr. Client, we're not choosing asset allocation here for you. We're going to keep doing what you're doing. We're just going to remove that from taxable world into the tax-free world. So the next page, Frank. And so how big of a problem are we solving? And that's what this next page speaks to. So what we've done, and the proof of this is in the back. What we can, when you guys get a copy of this presentation, you'll see kind of the proof of concept back in the back and all the calculations. But for this particular client, the $20 million allocation with those funds, that rate of return, those tax assumptions, is going to create a $69 million income tax problem that he will have to face or have to pay over the next 40 years. So between his age 50 and his age 90. On top of that, there's an accrued long-term capital gains tax that's not being paid because the portfolio is not being turned over 100%. And we've calculated that to be around $18 million. Remember, Frank mentioned this at the beginning, these assets are owned in trust and they're not going to get a step up in basis at death. And so he's got the current income tax bill that's due every year that he's paying on behalf of the trust. But his kids have this, they're going to inherit this $19 million tax problem, $18 million tax problem on these deferred long-term capital gains. And so we've got a total tax problem for this client of $87 million. And the good news is we can actually solve this tax problem now. And here's the impact to this particular client by simply relocating $20 million of taxable investments into PPLI and buying those exact same investments on the other side. So if we invested the very top line there, the brokerage account, you might call it a managed account, you might call it a portfolio account, whatever it may be. but 20 million over his lifetime will grow to $146 million. And again, we realize these are linear projections with returns that don't change and tax rates that don't change. That's not going to happen. But directionally, I think we can all agree that this is going to be pretty accurate within tens of millions of dollars, right? So we got $146 million this client's going to have on this $20 million growth over his lifetime on a net to heirs basis, again, because of that deferred long-term capital gains tax that's not being paid currently, right? That's a net to heirs of $128 million. Contrast that with that same $20 million being invested the same way. Again, 20 million gross to $313 million in PPLI and $330 million net to heirs. And the difference between those two numbers is simply that extra added death benefit that PPLI offers, because it's a life insurance contract. So said another way, we can pick up, 2% to, 2.5% of structural locational alpha outperformance simply by moving a client's portfolio out of taxable world and into PPLI. This is the tax assumptions page. We won't belabor this just in the interest of time, but just to show you guys kind of where we got the average capital markets assumption, the rate of return, the tax, all that fun stuff. You can see that, and we'll make sure this is included in the slides that you guys all get after this.
Right, and I think it's important just to note, Ben, these are not canned, right? We're receiving this information from the investment advisor, so they're determining the inputs, and we're just doing the analysis here.
That's right. And for anyone on the call that's in the investment management space, if you want to see different assumptions, we've run probably at this point thousands of these. So we've got, if you say, hey, I want to see this, we probably got it, but we're happy to run a custom one for you. Say, hey, show me a return rate of X and a tax rate of this with this amount of turnover. We're happy to show you. So no problem at all. Got a couple of questions that popped in real quick. Tom asked, why did you choose $20 million of the 60 to PPLI? How did you decide? This particular client, it was just a collaboration with the investment team. How much, what were the right assets to locate? Which ones did he want to move over? High return, tax inefficient was kind of what we picked there. But for every client, it's going to be different. Vimala and Ken, maybe you guys can speak to that real quick in the context of this case study. When you guys look at allocations of a client's liquid portfolio to PPLI, what's the math? What's the science? How are you guys, what are you seeing being allocated? How do you guys get to those numbers? All that stuff.
I think from our perspective, we really want to integrate it into the entire balance sheet. So, we take a goals-based approach when we're working with clients, which really is identifying what do you need for yourselves to live your life the way that you want to live it. What can we essentially allocate and tuck away and use for other purposes? And so typically we're seeing this as long-term money, right? Wealth transfer planning, multi-generational dollars for future generations. So we certainly don't want it to be, the bulk of, or even, I don't know, 40% feels like too much, right? This is really going to be locked up. In order to get the best return, in order to get the best performance, you really shouldn't touch it, although you can access it, which we talked about. It's certainly there sort of as an emergency fund. But in order to get the most out of this structure, you really should sort of set it and forget it and see these as the dollars you're not going to use. So just like we work with you guys on these customized tax analyses, we're also doing customized sort of cash flow modeling and reporting to really understand what portion of the balance sheet can we allocate, and make sure that we're doing it thoughtfully. And how does that fit into the rest of their structure? We can talk about that a little bit more, but sometimes you have to, factor in what trusts are in place, what cash do we have available, where is it all located, and really making sure all the pieces of that puzzle fit together correctly.
Yeah, I mean, this isn't really a widget, right? You're not just plugging and playing. I mean, there has to be a full conversation around planning and goals and objectives and all that. Ken, you want to speak to that real quick in terms of allocations and what you've seen historically people allocate to in terms of percentages or whatever?
Sure. Yeah, absolutely. So, just to follow up on what Vimala said, a lot of times what they do is, the product or this asset location, as I refer to it, is complementary to the overall sort of holistic investment allocation that the RA has for their client. And so it's a matter of determining weighting as to, based on the investment allocation model they have for the client, where's the best place to hold the certain allocations. And obviously the more tax inefficient the asset class, the sort of added value that holding it or allocating to it within the private placement life insurance structure makes the most sense. So, on average, we see a large predominant amount of alternative allocations through these SMA programs. Obviously, the credit space is one that's been having great returns and is seeing a lot of flow from there. So a lot of credit oriented portfolios and allocation models built over the last few years and currently from there. So it's really holistic approach by the registered investment advisor, determining where to best hold certain components of the client's overall global sort of investment pie.
And just to clarify, I don't think that we've actually touched upon this. Within an SMA program, the minimum capital commitment is $5 million. Is that correct, Ken?
Correct. You're looking at a commitment of 5, as you mentioned. So it can be 1.25 times 4 or whatever premium structure makes the most sense. That's where WealthPoint brings their added value to help with the case design and structure on the policy side. But
and by 1.25 times 4, you mean 1.25 million times 4 years.
Yes, that is
enough with the lingo, Ken. I know you've been around for 100 years, but come on.
I apologize. That's Philadelphia shorthand that you just got there from that standpoint. So yes, 1.25 million times 4 calendar years equals $5 million commitment. So that's a carrier commitment of 5 million. Also, that's a good number for a registered investment advisor. When you're building a bespoke custom solution, that gives them an amount of powder really to put something together that's bespoke and custom to get the value from a performance standpoint and build a robust allocation model. So it's a carrier minimum, but also fits right in the sweet spot, I think, from a minimum standpoint for a registered investment advisor to build a bespoke custom solution for a client.
Terrific. All right, Ben, you're back on it.
I'm back. This is a really awesome equation. The reason this whole thing works, and again, it's interesting in all these conversations that we've had with clients, is that there's all this mystery. I think Vimala spoke to that earlier, and Ken, you too. It's all this, we've heard about PPLI, and you look at the performance, it's amazing. And why does it work? It just functionally works because the client elects to pay insurance costs instead of paying taxes. And you can see the summary for this particular client on this page here. We've just summarized every 5 years on a cumulative basis what the cost of status quo, this is what they're already doing. And by the way, 20 million that grows to 146 million is a great outcome. Right? Any client's going to love that, right? But they're incurring more costs than they otherwise could or should by, again, relocating those to PPLI. So you can see, again, and this speaks to Frank's point as well, where he said, unlike traditional life insurance, the funds inside of PPLI are available day one because there's no surrender charge. You can see the costs were already ahead of the brokerage account, right out of the gate. The first 5 years, we've saved the client $1.2 million, and that account, that cost savings only grows over time and substantially. So, and again, so you can see over that 40-year period, we've saved the client $43 million in costs. But that amount, that $43 million again, is compounding, and that's what creates that $150, $200 million outperformance. This is going to be hard for you guys all to see on the page, but again, when you receive these materials, you're welcome to look at this in more detail. This is just a summary, side by side, year by year of comparing the brokerage account or the taxable account on the left-hand side with the PPLI account. You can see that we're all the way on the far hand right. What's the PPLI advantage to the client? So year one, we're behind by $39,000. But by year 2 and then every year thereafter, we're ahead. So again, just showing the client that this is not some, irrevocable decision, so to speak, where they've got if they put money in and they change their mind, they're going to be worse off after year 2 or later. If they change their mind, they want to get out of this thing. They want to start paying taxes again because they feel like that's more patriotic or whatever that may be. They're welcome to get out, pay the tax and move on. So we don't see our clients doing that. I don't know, Ken, how many clients you've ever seen in your career that have put a bunch of money into PPLI and then said, "Nah, this is for the birds. I want to start paying tax again." I assume the answer is 0.
No, it's I think I've issued design probably 1,500 plus policies, and I would say I think I had one client surrendered the policy at all. From there, they just don't. When you have what I refer to as a tax eliminated asset location on your balance sheet, it's highly unlikely you're going to try to do something like, you know what, I don't want that anymore. I don't want that anymore. I'm going to pick up my shield. I'm Captain America, and I'm going to go out there and I don't want this anymore. So, yes, to your point, once an individual has it, they will keep it because of the flexibility at the end of the day, right? Yeah. You have your preferred investment manager, maybe that team leaves and goes to another one. Well, you can go and reallocate to the new manager, so there's so much investment flexibility at the end of the day. You may decide, you know what, I want to, where I am in my life, I want to go and just get out of the alts and just go to a mutual fund. So I have T+2 liquidity and So all this flexibility, from day one all the way to the final day on the investment side, just leaves a reason. There's really hard reason for anybody to decide at the end of the day to surrender, like I said, at the end of the day, which is a tax limited asset location on your balance sheet. If you have it, you want to get more. You don't want to give them away.
Yeah, I was going to say, I would guess the most common example is not people walking their policies. It's, how do I get more?
Exactly right.
Yeah. All right, Frank, let's move on. Yeah.
Yep. So we had touched before about the fact that there's onshore policies and there's offshore policies. And speaking to primarily estate planning attorneys, I think that clients in the past have gravitated or not have availed themselves of offshore policies, perhaps for privacy issues, asset protection issues, and there are some maybe design issues, which we'll talk about in the second bullet point. But let's start with Vimala. Vimala, you guys currently are doing both. You've done both. Where are you guys at sort of on the onshore, offshore world?
Yeah, so I think a really quick important distinction is maybe that onshore, offshore has become a little bit of a shortcut for how is the policy funded. And so I want to make sure that we sort of draw those things out. So this gets to that design question that you're sort of hinting at, but usually we're using after-tax dollars, funding in cash, and then we're allocating and investing, from ground zero within the policies. That's how all of the onshore policies operate. And it's, that's the middle of the fairway, really clean, clear-cut planning that we talk about. Now, you can still do cash funded offshore policies. We see a lot of actual non-US people who may want access to US markets investing through offshore. PPLI is one really clear-cut example, which is actually super tax efficient for families looking to make those types of investments. I think where we potentially start getting into trouble is where you have, policies funded in kind. So we're taking existing positions, lifting them up and transferring them into offshore policies, or even, writing options contracts or doing even more esoteric things around privately held business interests. I think that's where we tip a little bit too far over. And that's really where we're seeing a lot of the sort of criticism and skepticism more recently. There certainly are lots of attorneys, maybe lots is an overstatement. There are attorneys who will write opinion letters saying that you can get around a lot of these issues and it's okay. Those transfers are taxable events, and there's a lot of design that goes into that, but more and more we're seeing people back off of that. So while we are currently managing some offshore policies that have assets that got in there that way, they're essentially cleansed now on the back end, and we're just managing the money on that same discretionary basis. Cresset's taken the position that we don't want to participate alongside with clients who are still looking to do these in-kind transfers. A lot of the skepticism and sort of criticism that's been coming up recently around, these feeling a little bit too aggressive and violative is something that we're trying to take a more careful standpoint on as well. So just want to draw out the distinctions because there are very legitimate reasons why you can use offshore, especially funded with cash. But I think it's when we tip over into those funding mechanisms that really we want to be a lot more careful.
Right. Because really with those funding mechanisms, what we're referring to are potential investor control issues. If you're responding to marketing that's talking about pre-liquidity planning for your business, that tends to raise some issues.
Yeah.
Ken, in terms of jurisdiction, of, so obviously there are certain states that are going to be more cost effective. And I think that's sort of an obvious jurisdictional choice. Can you talk to liquidity and investments within the private placement and why certain jurisdictions may be more favorable than others for future flexibility with respect to the underlying investments?
Sure, absolutely. So as you referenced, there's multiple reasons to consider when you're thinking about jurisdiction of where to have your policy issued from a state perspective. I think probably 96% of all PPLI policies are issued in Alaska, South Dakota, or Delaware, with Wyoming being added to the mix recently due to some state premium tax savings on their front as well. So from a cost perspective, those are the four sort of most efficient from a cost perspective. The second thing, and the one you alluded to, which is an area that not everyone thinks about when they think about jurisdiction, they think about the state premium tax savings. I'm going to go to one of these 4 states and The added benefit is from a carrier perspective. So carriers have 50 bosses in 50 states. Those are the insurance commissions. And in those insurance commissions, they have requirements in regards to, at the time of an insured's passing, how quickly they have to get the proceeds back to the beneficiary. Normally it's within 6 months. There are certain states that allow for what's referred to as unlimited deferral endorsement, to be for those carriers to create an unlimited deferral endorsement, place it in the policy of, put it in the back of the policy when they generate their contracts, or when they send it out to the policy owner. And what that unlimited deferral endorsement allows is an extension of how quickly they need to provide the ultimate total benefits, death benefits to the beneficiary. That is a long-winded way of saying this allows the manager or the policy owner have alternatives in their product from there. So this allows the Cressets or of the world with their SMAs, the IDFs like Millennium and Golub, to be held inside a policy owner's product and contract from an allocation standpoint. So these states allowing that unlimited deferral endorsement at the carrier level allows for these types of alternative or longer lockup period investments to be placed and held inside the policies at the end of the day, which is part and parcel to why the client is looking most likely to make a decision to purchase a private placement life insurance policy. So that's the added benefit. And then third, obviously, there's estate planning considerations. Different states have, potentially stronger asset protection laws and things of that nature. So that's really there's really 3 reasons why, when you think of different states to use as a jurisdiction. The driver normally is the the savings from a state premium tax standpoint, but the items number 2 and 3, the unlimited deferral endorsement and potential additional asset protection benefits to the end client, are also very viable and valuable to the policy owner.
Hey, Ken, let me ask you this. Do those 4 primary states offer the unlimited deferral endorsement?
They do.
So Alaska, South Dakota, Wyoming, Delaware, they're all kind of equal in that regard.
That's correct.
Yeah, awesome.
As far as ownership is concerned, we had talked about this offline. I think that we're all in agreement that virtually every single one of these private placement life insurance policies are held outside the taxable estate. There's nothing inherently wrong with it being owned personally. If someone, as Vimala had made reference to before, certainly that is a tax-free bucket during someone's lifetime, and it could be an efficient way for retirement income. It just isn't often seen. Ken, we did have one question though. When we were talking about investor control before, we talked about the policy owner. So obviously, if it's personally owned, the policy owner is the individual. If it's trust owned, the policy owner is going to be the trustee. In the case where there is a trustee involved, the investor control issues also apply to the insured. Is that correct?
Yeah, no, that's a great question. So it starts, if you will, with who's the financial benefactor, if you will, from that perspective? Whose money is this, right? It kind of starts the question. It starts there. Obviously, a lot of high net worth and qualified purchasers have very intricate estate planning done, where they'll have a multitude of different trusts found on their balance sheet, and some will be grantors, some will have themselves as trustee, a spouse, some will have an independent third-party trustee, depending on the structure and things along those lines. So the question normally starts with whose money is it at the end of the day, and then obviously the policy owner would be the trustee of the trust, wherever the money is being paid into the policy at the end of the day. But they take I would say, a holistic view, a carrier does, in regards to investor control, in regards to, let's make sure nobody wants to fly too close to the sun. So that's a little bit of a gray answer, but it does start ultimately, if you start the question is whose money is this and who are we doing this for? And then you can dive into the trust and the different things and things like that. And you can maybe find some ways to parse and do some different things. But ultimately, just as a general, it starts with whose money is this and who are we doing this for?
Yep. And Vimala, with respect to just sort of bullet point 3 and 4 combined, are you seeing most of these policies put into GST exempt trusts? And how would you say that the average client is thinking about this? This is a multi-generational asset. We're never touching it. This is looking at the great grandchildren. What's sort of that client perspective?
I think they come to it first from I like to save income taxes. How can we do it? So often that is the lead in, but then it actually allows us to have the wealth transfer conversation. So recently we're actually talking to a client who said, I want to do it. I'm not sure I actually want to use it for wealth transfer. And when we said, well, you're putting in $5 million, that's probably generating at least 20 million of death benefit. You already have a balance sheet of 30 million. I know you don't feel like you're taxable today, but when we tack on 20 million of death benefit on top of it, we're very clearly into estate tax land. And so it sometimes can actually be an impetus to get clients who otherwise might not be ready to start looking at doing some more advanced planning and recognizing that that's a really great asset that they can use to actually do the wealth transfer. So I think we've seen it work that way. We do have one policy owned by a client's revocable trust. He very much went into it with just, I want to be able to borrow against this. I want this to be my tax-free sort of Roth IRA equivalent in the future. And so, for them, we inherited that. We didn't help with the structuring, but that was his very clearly stated sort of goal up front. So it's not that it can't be done, but typically we do see this really being a nice add-on for either sort of kicking people into doing new planning or really just leveraging and making better existing planning that folks already have. They might have cash flowing assets already inside of a trust and they need to allocate those dollars. This is a great way to put some of that to use. And so we want to see how we can sort of make it all dovetail together, like we've been talking about, that it's integrated into the holistic plan over time.
Great. And it's great that we have the historian Ken Foley here to talk about this last bullet point along with you, Ben. Using existing life insurance or combining traditional life insurance with a private placement structure, we've actually seen a lot of uses for that over the last year. So Ben, why don't you sort of run through what that looks like, at least in this particular example?
Yeah, so thanks, Frank. I'm glad Ken is on here. Ken, as we get into this, did you actually help create this product? Is my memory serving me correctly on this?
Yes, that is correct.
Maybe you'd like to take these slides. I'm actually glad you're on here. So one of the great things is, and I'll ask for a little bit of kind of history on this as we get going, but traditionally, so if we look at this slide right here, we look at the top half. If we think about PPLI or any cash value life insurance policy, we think about it as a single policy, but it really contains two elements, and that's a net amount at risk or a life insurance benefit, which is the death benefit. But then there's also this tax deferred investment account that sits inside of that, if that makes sense, right? So in a ledger page, you'll see death benefit, you'll see account value, and the difference is that death benefit. So the opportunity that we have with existing life insurance policies, I think this will be particularly applicable to the trust and estates attorneys and CPAs on the call, certainly investment professionals that you guys know, you know, you have clients with large existing insurance portfolios. Through this magical product that Ken actually created, you can actually repurpose these products to create what we would call maybe like a synthetic PPLI. And the way you do that very simply, and again, we're going to do a deep dive on this in the spring. So be watching for that in terms of another webinar where all we talk about is repurposing existing life insurance for PPLI. But what we can do is we can assign the existing death benefit to the insurance carrier. This would be Lombard in this particular example, or there's another carrier called IPL. So we can assign our insurance to them. They in turn issue us a brand new policy that includes the value of that assignment. So that death benefit of 10, 20, $30 million, plus an account value that we can then contribute additional premiums to. So this is a great solution for a client that's done estate planning. They've done the gifting, the sales to trusts, whatever that may be. And they've got existing life insurance that they don't want to give up. They don't want to relinquish the death benefit, but they love the ability to contribute additional taxable dollars into a PPLI policy. Maybe they don't want to go through underwriting. Maybe they're uninsurable. This is a way to accomplish all those things. So Ken, before we move into kind of the result of what we could do with Catalyst, do you want to talk about a little bit about the creation of it and kind of the genesis of all that?
Sure. Yeah, absolutely. So, you know, again, this product was created. It's to Ben's point, it's referred to as, you know, it has a fancy name called Catalyst, but it's really synthetic. It's a synthetic life insurance policy where at the end of the day, as he referenced, you're using existing traditional insurance to create the death benefit of a new private placement life insurance product. And so the genesis of it really was kind of, you take a look at the marketplace and, you know, there's a tremendous amount of death benefit out there for high net worth individuals, and it's doing what it's supposed to do. It's sitting on a shelf, waiting for the insured to die and to be paid out, right? It's so from our view, when I was at Lombard, I know they continue that sort of same view set, is that's a wasting asset. So that's a wasting asset. We can repurpose that insurance to create what in essence is a tax-free investment account. The client doesn't have to go through reinsurance again. There is no cost of insurance charge in the synthetic PPLI policy. So from a cost perspective, it's much thinner, if you will, at the end of the day. So the cost and fees are lower. And for, as Ben mentioned, client, you know, maybe uninsurable today, whatever reason, doesn't want to go through the exam, all that sort of stuff. And why would you? Right? We have a wasting asset. Let's just use this. Let's maximize a client's mortality by getting 2 for 1, more or less, on their mortality. So that was the genesis of the creation of the synthetic insurance product known as Catalyst, and its application and use. I know they, you know, we printed a lot before I left, and they've done, you know, tenfold since I left. So this is a very, very popular product in regards to high net worth individuals. And to your point, CPAs and T&Es that may be out here listening today that are unfamiliar, this is a really valuable potential tool for you to consider for your clients as you look at them as you're doing their estate planning or reviewing estate planning that was already done, and seeing if there's an asset there that can be used to, again, in essence, create a tax-free investment account for your client.
Yeah, and Vimala, talk about kind of doing it all. You guys have done the offshore, the onshore. You've even done one of these. Yeah, I mean,
yeah, we've got a client who we work with. Actually, you guys helped us put this together and get it in place, and now managing with Ken. So, real life example how it really was able to solve a problem for this family and use existing policies to get something better in place for them. So we're really happy to be, I guess we're almost coming up on a year now of it being in place. And we're really happy with how it's been working.
Yeah, awesome. And then Frank, if you'll just go to the next slide, I think this is just our summary of the improvement to Ken's point, this wasted asset. The return and the tax assumptions were a little different. We put that at the bottom right there, but you can see for this particular client, they had a $25 million death benefit. It was a survivorship product. Interestingly, it was, again, put in a trust for estate liquidity purposes, and they needed to maintain that, right? They needed the $25 million of liquidity. So the question was, hey, how much better could their financial position be by simply using this Catalyst product and wrapping it and allowing them to contribute some money into the PPLI account. So what you see the top line again there, the $13.8 million, that's a reverse solve. That's like, hey, if we assign $25 million and create this synthetic wrapper, what's the most amount of money we can put in? That's that $13.8 million. It will grow to $76 million taxable over their lifetime. So you can see a net to heirs basis is a great outcome. If they do nothing, their heirs are going to get $92 million, which is tremendous, right? But if they take their existing policy, they assign it to Lombard. Lombard gives them this new catalyst policy. They can put that 13.8 inside PPLI. Now it's growing tax-free, tax-deferred. They end up with $161 million on a net to heirs basis at their life expectancy. So again, an improvement of $69 million, again, merely by taking a wasted asset, an asset that's otherwise sitting there, and it's doing what it needs to do, by the way. Again, this is not a bad asset, but we're just repurposing it and making it more efficient and maximizing their mortality. So we think it's a great outcome for the client, and there's a lot of this on the books that we think we're going to be able to help improve client outcomes just by using existing life insurance.
Great.
So I think the next page, Frank, is a Q&A page, there you go.
We did have a question come in, and you referenced on the last Catalyst page about it was a survivorship contract.
Yeah.
Maybe you all three panelists can talk about individual contracts versus survivorship now outside of the Catalyst world, right? Just in regular, when we're designing traditional PPLI, why would we gravitate towards individual versus survivorship or not, and maybe MEC or non-MEC, and what are those considerations? And Vimala, maybe you could talk about, right, those real life examples of like, if a family is thinking about this for the great grandchildren, are they just creating a MEC and getting more money in earlier? So Ben, I don't know if you want to take it or Vimala start there.
Yeah, Vim, you go ahead.
Start with MEC. Okay, so really quickly, in order for life insurance policies to receive all of these great tax benefits, right, the ability to borrow on a tax-free basis, you need to structure it with, we'll call it Ken's, 4pay 1.25, right? I don't know his Philly lingo, but essentially, typically, we see structured over time. So premiums going in over a period of years to make sure that we're qualifying for, the policy to actually be treated as insurance and to get all of these wonderful tax benefits. The downside there, right, is that you're not getting dollars to work as quickly. And so it takes a little bit longer to sort of kick in, start generating those compound returns, and really to start growing on that exponential basis. The alternative for folks who aren't worried about borrowing and don't really need to get that kind of emergency access to the policies is just to fund it up front. And then it's a modified endowment contract or a MEC. And so there you have all the dollars being put to work immediately, and you really can kind of kick it off and start growing, as quickly as you want to. I'd say by and large, all of ours have been, non-MEC policies, although we certainly talked about MECs with some clients. Interestingly, also in an offshore context, right, where we have offshore trusts with significant UNI stuck in them. And so seeing how we can use a MEC contract as a way to potentially start cleansing and being creative from a tax standpoint. So I would say that tips over into the more complicated area of how you might be able to use the different types of PPLI to structure a really interesting result. But for the most part, we are seeing families like to maintain as much flexibility as possible. And I think that's probably just a carryover from how a lot of us estate planners think about planning. If you can have flexibility without too much downside, like, why wouldn't you, frankly? You don't always know what circumstances are going to be in the future. And so, if we can structure it in a way where we're not leaving too much behind from an investment return perspective and maintain the most flexibility possible going forward, that tends to be where we wind up.
Yep. And Ben, when we're thinking about individual versus survivorship, my mind goes to design considerations, right? And so would you say the majority are individual policies, and because the death benefit is we're able to manipulate, and I mean that in a good way, not in any type of unseemly way, right? We're able to get rid of those costs of insurance charges in a different way than we otherwise could if we used a survivorship policy.
Yeah, I mean, Ken, you could speak to this too. I don't know of any carrier that offers a survivorship PPLI policy, do they?
I know one.
Oh, okay, there's one. I mean,
So-
it's the point, again, going back to kind of the design objectives, when you use PPLI, you're chewing up a lot of capacity for a client, right? And so most clients, when they buy it, as Ken mentioned earlier, they often want more once they see kind of how it works. And so you wouldn't want to use, from a death benefit perspective, you're limited on how much you can buy per individual life. And you wouldn't want to, put $100 million on a his and her. You'd rather do 50 on him and 50 on her, preserving the ability to add more later if you wanted to. So in a real simple, quick answer, that's what we see from a design perspective. And very few, all but one carrier doesn't even offer the survivorship. So it's really not even an option in the marketplace.
Vimala, Ben brings up a good point. When we talked about these really are legacy type policies. So if we were in the traditional insurance world and we were trying to solve for estate tax liquidity, right? We're clearly looking at G1 in that particular instance. When you're talking to families and you are, this isn't for G1, right? Yeah. Do you see a lot of families looking downstream to G2 to say, well, why would we just want these tax benefits for 20 years on G1? Let's go down to the 40-year-olds and have it for 50 to 60 years. Is that something that you're seeing?
Very much so. We've had some ask if we could do their high schoolers. I think that's a little bit too young. But yeah, certainly if we've got sort of young adult family members, oftentimes they get better health ratings, right? Just given where they are in life. They also are going to have tax problems being inheritors of really large estates. So they're still insurable from that financial underwriting standpoint. And we really can just increase the value and the return of, the proceeds in the policies over that longer duration. So I think it's a great call out. The one thing that I wanted to mention that I neglected to earlier is that, especially when we're looking at these really large grantor trusts, where oftentimes these are owned, the tax drag on these really significant trusts can become very, very large over time. And so I like using PPLI as a way to insulate a portion of the assets in the trust and really to cut off the tax burden that the grantor has to carry while still generating this significant return. I think it's another nice, interesting way to get there rather than turning off grantor trust status or worrying about reimbursements or loans. This really can work nicely together and give, I think, a much better result overall for the family. So I just wanted to flag that as another, sort of really important way that this can be used as part of an existing structure. And, especially even more if it's on the kids as well. It will protect the trust once it flips over to non-grantor with G1 being gone. It also is still going to provide that sort of tax insulation for what would eventually be a non-grantor trust as well. So
terrific. Thanks. Ben, do we have time for one more question?
I think we are at our time, but people can drop off if they have to go, but we ought to answer the last question, I think, that came up here in the chat if you want to do that.
So Ken, I wanted to ask you about, we haven't really focused on single family offices. So can you provide just a 30-second high-level overview of how is it working with single family offices? Because we touched upon investor control rules, how is that playing out? Because we do know that single family offices are definitely using private placement.
Yeah, absolutely. So in most cases, single family offices will work either with a trusted RA, like a Cresset, to build a allocation model, build an IPS, build an SMA for them in partnership. As a single family office, there would be too much investor control violation or concern of from there, because the single family, the patriarch, would have too much undue influence on the single family CIO in regards to do what I say or I fire you from there. So single family offices would not be in a position to, in most cases, to manage inside a policy themselves. They would have to partner with a third-party investment manager like a Cresset, or work with a fund manager to create a what we call a private IDF, where they build an IDF specifically for a family. This third-party investment manager, we do actually have quite a few private IDFs where investment managers are selected by a family. They build a mandate specifically to them. They agree to put in X amount of dollars and they launch a fund for that particular family. So in most instances, that's the partnership. And the other thing I would say in regards to single family office, if they really want to manage the money inside the structure, that's probably a broader conversation, because a lot of times single families actually start off as a single family, but over time, there are now multiple families, but they like the cachet of calling themselves a single family. When ultimately now they have G2 and G3s on the way. And so there's multiple families in there, but it started as a single family. So part of that's just a conversation to say, I hear you like to call yourself a single family, but are you a multifamily now? Or are you just literally just a single family? So those would be the conversations. And just as you agreed, all done in under 120 seconds.
There you go. Awesome. All right. Well, thank you. Ben, you want to?
I was going to say, as we wrap up, thanks everyone for your time. I would say if there's any RIAs on the call that would like to know more about the administration side, how onboarding works, whatever, reach out to Ken. He's the Yoda of PPLI, and he can help you get set up. And if you're an RIA and just want to know how it works practically, Vimala and her team would be a great resource. They've got a real hot shot over there that is leading their PPLI efforts.
That I stole
Story
from
behind
WealthPoint, don't tell them.
But anyway, they would be great, and it would be a resource to you. They'd be happy to tell you guys. I'm not just offering. They've told me this, that they would love to help anyone who wants to get this as a part of their offering. They'd be happy to help you guys understand what's going on and what's worked, what hasn't worked, things like that. So reach out to them. They're a resource to you as well. And again, if we can be a resource to you or your clients, you want to see tax analysis, you want to see how this might work in your situation. If you've got a catalyst, or if you've got an existing insurance policy, you want to see how Catalyst might work, let us know. We're happy to run those numbers and have a conversation. So we're grateful that you take some time with us this morning. Thanks, Vimala. Ken, thanks. You guys were awesome.
Thank you for having us.
Thank you for having us. Appreciate it.
You got it. And until next time, thanks everybody.
Thank you.
Take care.